Hi traders, and welcome to my video on the forced index indicator. This is a technical indicator that measures the strength of buying or selling pressure in a market. It can be used to identify trends, potential turning points, and reversals. In this video, I'm going to show you how you can use this indicator to capture moves such as this one for around 300 pips. So this is the MT4 trading platform I'm using here. Okay, this is a US dollar, Canadian dollar 1 hour chart. Below the chart, you see the force index indicator. I'm using the default periods of 13. Okay, so in this video, I'm going to show you how I use this indicator. Okay, there's different ways you can interpret it, but first thing I want to do is I want to look for a trend. Okay, this is a 1 hour chart. I prefer to trade the higher chart time frame simply because I find the signals tend to be more reliable due to the fact that there's more price data included. So I'm looking at the 1 hour, the 4 hour, the daily, the weekly, and the monthly charts. That being said, you can use this indicator on any chart time frame and any trading instrument, whether that's Forex, stocks, cryptos, commodities, indices, etc. Okay. So that being said, the first thing I do is I look for a trend. So we have here our resistance level. Okay, and we have here our support level. Okay, it's a nice triple top pattern here. It means the resistance has been tested at least 3 times, 1, 2, 3. And then we can expect a breakout to the downside along a neckline here, which is the support within the triple top pattern. We also see that the market is making lower highs here. So we're expecting a turn to the downside. We also have this bearish price action. Okay, you have a 3 inside down formation there. That's a bullish candle followed by bullish candle, bearish candle, that's at least 50% of the bullish candle, then another bearish candle which falls below the initial bullish candle. And you can see that pattern was formed again here. Bullish candle, bearish candle, and another bearish candle breaking out below the low of the bullish candle here. Okay, so that could have been a potential entry point. Okay, we're not actually using the forced index at this moment in time. I don't tend to rely heavily on technical indicators for taking entries. However, I do understand that they can be good for filtering perhaps when to avoid trading in overbought or oversold market conditions, and also for helping to time entries into trends. But I prefer to just keep an eye on price actions, support and resistance, various candlestick formations and patterns such as those there. Okay, so we could have entered on this breakout up here, this breakout here. Either way, we just want a trend to form. Okay, so if we wait around here, you can see there was the breakout there of this line. We have the pullback, and then this is where the force index indicator comes into play. So this indicator basically, when it's above this 0 line or it's increasing in value from below, it suggests that there is buying pressure. Okay, and when it falls below the 0 line, it suggests that there's selling pressure. Again, it doesn't have to be below the 0 line for there to be selling pressure. It can be high, but if it's declining, it suggests an increase in selling pressure, and you can expect a move to the downside. Vice versa, if it's climbing upwards, the indicator, you can expect perhaps a move to the bullish side. Things to look for with this indicator are divergence. Okay, so if we have the indicator making higher lows, we can expect a possible turn to the upside, just as if the indicator is making lower highs, we can expect a fall to the downside. Often it just replicates what you can see looking at your charts. Okay, just as I said with this triple top pattern, you also have an M formation here. Can you see there? Up, down, and then a breakout on the last part of the M. I'll just show you again with the mouse. M, you see that? Okay, I do have a video on the M pattern and the W pattern, which is basically that in reverse as well, worth checking out. But we make our life easier by trading with the trend. That's the most important thing to reiterate here. So once you see the trend forming, if you wanted to wait for the breakout for confirmation, then we could have entered simply based on that support breakout. Again, this indicator, I'm not even using the indicator. I'm just trying to show you that you don't necessarily need indicators. You could have taken that trade anyway. Okay. on that breakout. We see there's a downtrend, enter on the breakout. But if we must use the force index indicator, this is how I would use it in this scenario. So as this trend is falling down, okay, you can see that the force index indicator is making lower highs. So that's just confirming the downtrend. Okay, it's obviously dropping from up here to below the zero line. So we know that there's selling pressure, as the chart would tell us. We don't necessarily need the indicator to tell us that. However, it does, okay? This is the key thing to look for, is timing the entry into the trend, because you're not going to just sell here. After this down bar, you might get excited, see there's a downtrend and want to sell, but you're going to sell at the low and possibly get caught in a bear trap, okay? Same as if you open your chart and you're here, you might say, oh, it's a downtrend, let me jump in, you sell there and the market reverses, okay? Same here. You want to time your entries. So I like to time my entries on a pullback, okay? Like I showed you here with the pullback there and the breakout below the support level, okay? And you can use the force index indicator to help you identify pullbacks. So how do you do that? You basically wait for it to be showing a downwards trend, as it is here, bearish divergence, falling down below the zero line, as I said. And then when it comes back up above the zero line, this can be the indication of a pullback area. Okay, so it comes back above here, and this is the area of pullback we see on our chart. And from then on, you can wait either for a cross back below the zero line as an entry point, okay, which would be up around here somewhere, which is a good entry. However, there will be instances where price continues in an upwards direction or perhaps consolidates for a while, which is why I like to wait for the breakout of the nearest support level. Okay, so as soon as you see the cross up of the force index in the opposite direction, that's the pullback, and you just decide if you want to sell on the cross back below or the next break of support, and that's for a sell trade. We'll look at the opposite scenario for a buy trade in a minute. Okay, so either way, let's just say we took this trade here. Okay, the pip potential in this move over 200 pips, okay? That's had we not got in earlier here, but you know, we could have, or we could have just waited for confirmation for this trend, because there could be instances where price bounces again off of this level of support and continues in the other direction. So this is perhaps a riskier entry, but still you could have had a stop loss above this level of resistance here anyway, just as for this trade. Had we taken the breakout trade to the sell side here, I probably would have initially put my stop loss just above the recent high, which is only 20 pips, which for a 1 hour chart time frame is very reasonable, especially when you consider there's over 200 pips available in this move. You're looking at a 1 to 10 risk to reward ratio at least. Obviously, not everyone's going to exit perfectly there at the bottom of the move, but this is why, as price moves down, okay, and then has a pullback, I would move my stop loss from the entry to the recent highs. So here, and after this move down and a pullback up here, I'd move it here. After this move, consolidation, drop down, my stop loss would move here. This move, further drop down, my stop loss would move here. So I'm just basically locking in as much of the trade as possible. So if price does turn around, which it eventually will, we won't be leaving too much pips on the table. We'll be maximizing the move as much as possible. What you wouldn't want to do, or what I wouldn't want to do, is see this breakout here with a 20 pip stop loss and get excited if I hit 60 pips. Oh, 3 to 1 risk to reward ratio, let me exit, I don't know, here somewhere for 60 pips. Just leaving a lot on the table. I mean, granted, if you do that, you can always re-enter on another pullback. For example, here you can see this level of support was formed. Nice strong level of support. It's a triple, double bottom pattern. M formation again. You see the M letter. Okay. Down through there. So that big bar there signifies that traders were watching this level. A lot of traders anticipated a breakout to the downside to continue with this trend, especially as the market was continuing to make lower highs. This is a wedge formation. Or descending channel, if you like. Lots of bearish candlestick formations there. It's just clear indications, and there's no coincidence there's that big bar there. Okay, force index for this trade. let's not forget the indicator we are actually talking about here. As I said, when it crosses back above the 0 line, which it did here, that's the pullback really, and we would have been thinking about looking for an entry either on the cross back below the 0, which would have been up here, or the breakout, as I said, around here. So the force index, if you don't want to look at a chart and you just want to look at an indicator, it will tell you the same thing when there's a pullback. You also had the bullish divergence there, showing that the market was moving to the upside, and in fact, just before the entry, you had a nice bearish divergence there as well for extra confirmation for this particular trade. As you can see, would have been a good trade just to get in at the end of this move and capture a nice amount of pips. How many would we have been looking if we got out around here? Around 130 pips in the space of a couple of days is not bad at all. Try getting that on a 5-minute chart time frame in a couple of days. Good luck with that. So basically, we're looking for a trend. We're looking for pullbacks, whether you look for them visually and draw your own support and resistance, or you use an indicator to help show you where the pullbacks are. I mean, here's another one. If we just go back here, this was the initial entry on that pullback, if you remember. And then there was actually one here as well, which would have been a potential entry point. Still would have been a decent entry. Again, you could have used your support level, which eventually became resistance. Okay, so you see that force index pullback around here. Could have entered on the cross below again, or the breach of the support level, which eventually became resistance. That would have been actually good confirmation for this trade here. If we wanted to get in early prior to this breakout, we would have seen that, okay, well, this level of support is obviously holding up now as resistance, been touched there. There's in fact another triple top candlestick formation, 1, 2, 3 breakout on the neckline to the downside. I do have a video on the triple top candlestick formation you might want to check out. Good to be aware of these things on your chart. We had the force index pullback again up around here when we touched this support and resistance. So again, further confirmation. Plenty of ample opportunities to get in on this downtrend. We don't need no fancy unicorn magic indicators or anything ridiculous like that. Just good price action analysis, timing our trades, and of course, as always, sensible money management. Cutting losing trades short is what I like to do, and let winning trades run, maximizing the move as much as possible. Okay, traders, now I just want to show you a bullish example using the force index indicator. So we're going to do the same principle. We're going to mark a support level. Okay. Resistance level as well. Okay, so we're going to wait for the price to break out. We can see the market's making higher lows, so we're expecting the uptrend. We have the breakout of this resistance level here. Okay, after the breakout, the resistance level holds up as support, so some traders may have entered here, aggressive traders. Others would have waited perhaps for the move to continue upwards. And there's ample opportunities on this move. If we just look to enter on a breakout of resistance, the reason we're doing that is because the market is trending up. The trend is your friend, and we can just mark resistance. Look at this breakout candle here. No coincidence to the upside. Could have entered on a breakout there, a breakout there, a pullback onto the support, and you will see there's moves like this all of the way up. Simple trading, naked trading, if you like. That's what they call it when you're just using candles and price action. I mean, this form of trading has been around forever, so you don't really need no kind of magic indicators. People are trying to sell you. You can use them if you want. But talking of indicators, but basically indicators show you what the price action. They can be lagging as well. Price action shows you what price is doing at any given time, whereas indicators can be lagging. They can repaint. They can change after the fact. Nothing beats price action in my opinion. But that being said, let's look at the force index indicator. So these would have been all possible entries on this uptrend here. Many opportunities to get in around the pullbacks on the trend line, the breakout of the resistance. Let's just say you took the first breakout. I mean, you're looking at around 300 pips. Not bad. Again, you could have used a trailing stop. Initial stop loss below the low. If you entered here, stop loss just under here, around 25 pips. We entered on this breakout below this low here. around 15 pips, really tight stop loss for the 1 hour chart time frame, and then we can just trail the stop loss as price moves up, put the stop loss below the recent lows, lock in our profit, perhaps close part of the position on the way up just to bank some pips. You could even use the trend line price on the other side of the trend line for the trailing stop as well. So yeah, force index indicator, getting carried away now, but if we wait for the pullback, so it's the opposite principle what we did for the sell trade. We're waiting for the force index to pull back below 0 because we're in an uptrend. So it pulls back around here. Okay. Arguably here, it doesn't have to be set in stone. I mean, if it gets close enough and starts turning around, it can be a signal. You know, you don't have to be only if it crosses the 0 line. Yeah, this is the thing about indicators. If you use them matter of fact, you can miss opportunities. But then there are times where they keep you out of trouble as well. So if we go matter of fact, we have the crossover here and the cross back up. So this would have been an entry in the trend there. Okay. As price continued up, up, up. Yeah, arguably here again, didn't cross 0, but like I said, it came close enough. If we want to do matter of fact, crosses below 0, crosses back up here. Okay, so that's another entry you can see, timed perfectly into the trend. You might want to be wary as we keep, you know, the higher we get, you don't want to get in too late on the trend. But still, there was some gas left in the tank around this pullback here. Okay, here as well. But then once we start to see the bearish divergence, you might want to think about not taking trades because we don't want to buy too high. You don't want to buy at the high. You know, there was ample opportunity to get in earlier on this trend. Why buy at the top? You know, we don't want to buy high and sell low. We can just wait for the next opportunity, whether that's on this chart. I mean, there's so many different trading instruments you can look at, and chart time frames. You don't need to force trades that aren't necessarily there. And again, this bearish divergence to the downside could have been a signal that the momentum to the buy side is slowing down. So start exiting the position once we see this choppy market as well, get price getting trapped in a range. Okay, these bearish candlesticks, we might want to think about exiting the trade. Hopefully that has given you an idea of how the force index indicator can be applied to your trading strategy. Again, just to reiterate, when it's going up, it suggests the market is moving up. When it's going down, it suggests the market is going down. You can use the 0 line to look for pullbacks, look for your bullish and your bearish divergence for extra confirmation. And as always, keep an eye on candlestick patterns, your support and your resistance and trend lines. And perhaps most important of all, sensible money management. I hope you've enjoyed the video. If you can please like and subscribe, that would be great. I'll catch you on the next one. Thanks for watching.